Hi, my name is Jamsi. I'm a finance professor. Welcome to another video. So today we're going to be starting a new module in strategic business analysis. Last time we talked about the characteristics or the types of analysis that we need to do when we're doing business analysis and the considerations that we need to look at. So for today, we're going to skip right on ahead to step one of business analysis, which is accounting analysis. So for this module, we're just going to talk about the overview of the accounting analysis process and how it works. All right, so let's begin. So as we know, businesses are actually required to present financial statements regularly. And from your accounting classes, we know that there are different accounting reports or financial reports that need to be presented in the financial statements, meaning you need to show the statement of comprehensive income or your P&L statement. Second, your statement of financial performance or your balance sheet. Third, the statement of changes in equity. Fourth, the statement of cash flows. And of course, last but not the least, the notes to financial statements. Because without the notes, we will not be able to further our understanding on each of these statements. So we really need to have our financial reports accompanied by notes to financial statements. Because in order for us to be able to evaluate effectively the quality of the firm's financial statement data, we as business analysts need to understand the basic features of financial reporting and the institutional framework that governs them. All right. So, with that being said, let's recap the basic features of financial reporting. So, one main feature of financial reports is that it assumes a going concern, or it is going to assume that the business or a company will be operating continually for a foreseeable future. This is the reason why the numbers in our financial reports are reported on accrual basis accounting. So, in accordance with going concern or in accordance with the going concern assumption, we are forecasting that there will be no bumps ahead and our business will live on for a foreseeable future. With that being said, our method or our accounting basis should follow that assumption. And the main accounting basis that is being used in financial reports is accrual basis accounting. So as a recap, accrual basis accounting follows the matching principle, meaning revenues are recognized in the period they are earned, regardless of when income is received and when the expense is recognized during the period when it was incurred, regardless of when it was paid. To make the long story short, you need to recognize the revenue during the period when you were already or when you were able to fulfill your obligation as a service provider or as a vendor of goods. And at the same time, you are also required by the accounting standards to recognize in that same period the expense you have incurred in making the sales transaction. That is the main meat or main gist of the matching principle. Now that we are refreshed about going concern assumption and accrual basis accounting, let's move forward with another basic feature on financial reporting. And this is the generally accepted accounting principle. So, the generally accepted accounting principle is basically the Bible and the set of rules that accountants will follow in preparing the financial statements. So, there are two main standards or accounting principles that are accepted. And depending on where a business is situated or domiciled, a business may prepare the financial statements using the US generally accepted accounting principles or the international financial reporting standards. Next, we have the management responsibility on accounting. Now, when we talk about management responsibility on accounting, we are talking about the assertions made in the financial statements. So, when we talk about the responsibility of preparing the financial statements and so vouching for the veracity of the reports made, therefore, it is the responsibility of the management. So whatever the management puts on the financial reports is their accountability. And these assertions were made using their knowledge of the business and their professional judgment. Of course, if the management is responsible in preparing the financial reports, there is also a need for external auditing. So, in the last module, we said that auditing by a third party increases the reliability of a financial report. So external auditing basically is the verification of the integrity of the financial statements as reported by someone other than the preparer. So in auditing, what basically happens is that a third party is contracted to verify the integrity of the reports prepared. That is why auditors are actually giving their opinions based on what they find as a result of their audit in the company. So external audit actually ensures that the accounting policies and procedures are used consistently and accounting estimates are stable. Last basic feature is legal liability. Now, what does this mean? The threat of lawsuits and penalties improve the accuracy of financial statements. However, potential significant liabilities may discourage managers and auditors from supporting accounting proposal where management and auditor judgment and increased complexity or nuance come into play. So it's not just about the financial reporting standards then. It's not about the management responsibility or the presence of an external auditor. More so, it is also about legal liability. Who will fall in case there is a misstatement in the financial reports? So, as a result of multiple controversies in the past, where companies such as Enron and Arthur Anderson took the fall, Sarbanes-Oxley Act was born. And we have discussed this in the previous modules. Because there is a possibility that it's not just the management who can go to jail due to material misstatement. It could also be the auditor that could be accountable for a materially misstated financial statements because they are the ones who verified it and said that it could be relied upon, but in fact it is not. So these are some of the basic features of financial reporting. Now that we know about these things, let's recap. What are the factors that affect accounting quality? One factor that affects accounting quality is the noise coming from accounting rules. So when we say there's noise from accounting rules, we don't literally mean the noise like what we hear from other people or from the streets outside. So accounting rules introduce noise and bias because it is often difficult to restrict management discretion without reducing the information content of the accounting data. So, believe it or not, regardless of how we want our accounting to be standardized, the choice of accounting rules from the list of acceptable options show that in one way or another, management is biased. So it's difficult to actually restrict management discretion without actually affecting the information content of the accounting data. So when we're talking about noise from accounting rules, there could be 3 potential sources. So number 1, noise could be introduced in the rigidity of accounting rules. So as we know, our financial reporting standards is like a Bible. It's a rule book that contains what is acceptable and what is not. And it prescribes the structure and at least the bare minimum that can be presented on the financial statements. Because these rules are very black and white, while the intention is good, following these rules could skew or could affect the quality of accounting data because the rules that are set in the accounting standards may not be 100% reflective of what's actually happening in the company. Second, noise in accounting could be introduced in accounting data from random forecast errors. So, because we are only human and forecasting is mostly performed by human analysts, we could not perfect it. We can't perfect our forecasting. Why? Because when we forecast, we rely on the data that we have. And of course, the data that we gather are also products of human extrapolation. And sometimes the data that we rely on contains errors here and there. And in the process of doing the forecasting, we could also commit errors in the calculations, in the percentages, and the estimates that we use in our forecasts. Therefore, it is not 100% accurate. And third, these are because of the system. So this noise is existing because it is systematic. So depending on the process of the company being employed in some of the major transactions, it could also affect the quality of information that we have. As accountants, in as much as possible, we would like to get paper trails and we would like to document our work. And if in our processing of transactions, there are already inherent causes of inaccuracies or errors, therefore, we could not take out those errors because it is inherent already in the accounting process or in the company's accounting system. Therefore, broadly speaking, the degree of noise or distortion is introduced to accounting, and it is depending on how well and how uniform accounting standards capture the nature of a firm's transaction. So think of it this way. Accounting standards are like fish nets. And when we go out to fish, depending on the size of the net, we can capture anywhere from a small fish to the biggest fish that we could find. But true enough, even as we cast our nets, we don't always catch all of the fish. So we must be able, as accountants, to find the best fit in terms of the nature of the firm's transactions and match it with a corresponding accounting standards. But what if there is no perfect match because the standard does not fully reflect the nature of the firm's transaction? Then what are we taught to do? We are always taught to look at substance over form. And sometimes things like this can cause distortion in our financial reports. All right? So another factor that affects accounting quality is, like I said, forecast errors. So managers cannot predict the outcome of future consequences of future transactions. So, like I said, we only base our forecast from previous events. And these previous events or these historical events may not always be correct. And if we're right, then great. We have made the right decision. But if we are wrong, then it could result into a catastrophe. So the extent of errors in the manager's accounting forecasts depends on a variety of factors that includes the complexity of business transaction, the predictability of the firm's environment, and unforeseen economy-wide changes. So let's say, for example, A food chain such as Jollibee might have thought differently before the pandemic. They might not see food delivery as a very lucrative business. And they were relying on third party booking applications to cater their delivery services. But what happened during the pandemic? Because during the pandemic, people were not allowed to go out and people were not aligned or people were not allowed to go out. The brick and mortar stores of fast food chains were empty. So therefore, they did not see the pandemic coming. The change in the behavior of the economy and the buying and consuming pattern of the public actually changed during the pandemic. So what did they do quickly? In order to adapt, they converted their brick and mortar stores as delivery hubs. Sorry. So what did they do? They opened a designated store where delivery drivers would go pick up orders and deliver it to the buying public. So therefore, with that setup, they were able to continue doing business while actually keeping up with the needs of the consumers at that time. So if they were not able to execute correctly, we might have not seen a huge jump in Jollibee Foods Incorporated stock price going up. But in that example, there is already a forecasting error because the forecast prior to the pandemic was dependent on the fact that plenty of people would be dining out in the entirety of 2020. Walang pandemic nung 2020 when they made the forecast. So, if there was an error in the forecast, they would not have seen the pandemic coming. And obviously, their forecast was wrong for 2020. It's a good thing though that they were able to adapt and make the changes quickly. All right. The third factor that affects accounting quality is managers' accounting choices. So, whether we like it or not, as finance personnel and as members of the management, we also introduce noise and bias through our own accounting choices. So, the accounting quality of a company's financial information is actually dependent on the choices made by the managers. So like I said earlier, based on our choices in terms of the accounting policies and standards, we would also be able to determine what works best for our company and what might not be the best. But what may be the best in our minds as managers may not be reflective of the real essence of the transaction. So depending on the accounting choices that we make, the accounting quality would also be affected. So let's take a look at the management choices. So here are some factors that may affect the management's accounting choices. All right. So In doing business, we always have covenants or we always have contracts with third parties. So we have what we call accounting-based, debt covenants. So when we talk about accounting-based debt covenants, our contract has a stipulation that is depending on a certain number that could be found or could be derived at using a corporation's or a business's financial statement. So let's say, for example, one stipulation that a company may have in its debt covenant is times interest earned ratio. So in theory, let's just say that a company is requiring a times interest ratio of 4. So in order to maintain that times interest earned ratio and follow the word of the debt covenant, the managers may make accounting decisions to meet that specific stipulation in their debt contracts. All right, so that's what we mean when we say accounting-based debt covenants. So the violation of accounting-based debt covenants may be costly because lenders can trigger penalties, including demanding immediate repayment of the loans. So the managers of firms that are close to violating debt covenants have an incentive to select accounting policies and estimates to reduce the probability of covenant violation. So this is one of the biggest driving forces on how the management chooses its accounting policies and procedures. Second, management compensation. All right. When we talk about management compensation, we talk about the remuneration that managers receive as they continue to be employees of the business. So the accounting choices made by the management can be influenced by the fact that their compensation and job security depends on profits. If you would remember, one of the interest groups that would surely use the financial statements for their own benefit are the employees, because they want to make sure that the company will be able to pay them their salaries and benefits. So as a result, if you are depending on the company for your daily living, therefore, you have the incentive to choose the accounting policies and estimates that maximize your expected compensation as an employee. So let's say, for example, one provision in your contract says that if sales is increased by 10% year over year, you will be receiving a 5% bonus. So, of course, you would want to hit that target in order to get the additional compensation. So, because of that particular motivation, you would also have to align your personal interests with the best accounting policies that would show the results according to the stipulation in your contract for the additional compensation. All right, I hope that's clear. Third, corporate control contests. So, as we know in business, one day you're in, the next day, someone else may own you. So, because there are two groups in any businesses, the minority stakeholders and the majority stakeholders, there are also two conflicting interests. So, because there are different factions in the organization, we can't also help but notice that there is, to a certain degree, a quest to take hold of the business, the quest to be in control. So, because of this, competing management groups will favor the accounting policies based on what they feel would be in the best interest of the firm. And because they would like to win over the firm's stakeholders, they now have the incentive to align their quest for corporate control on how they would choose their accounting policies. Because accounting numbers are used very extensively in debating a manager's performance in these contests. Therefore, the managers that are being evaluated using the figures found in the financial reports may make accounting decisions to influence investor perceptions in corporate control. So, of course, as a manager, you want to show that you are in control so that you are also able to stay in your position. Because the evaluation of a manager's performance is highly based on the numbers. Therefore, with that knowledge or with that parameter, a manager may choose an accounting policy that could favor him or her in that department. All right? So I hope that's clear. We have a few more examples on why the management's accounting choices could affect accounting quality. Next, we have tax considerations. All right. So, as we know, tax is inevitable. To some degree, these businesses will pay taxes. But the question is, it's not when, but how much tax these businesses will pay. All right? So these managers may also make accounting choices to trade off between financial reporting and tax considerations. Because in some cases, when a manager is after tax savings, then the accounting data must show that there are a lot more expenses than revenue. So in order to show that, there should be appropriate accounting policies and estimates to back that up. So if there are far more benefits in taking hold of these tax savings, then managers may actually choose accounting policies and estimates that are more favorable for tax purposes. However, some firms may forego the tax reduction in order to report higher profits in their financial statement. So in some cases, we're not going after the tax savings, but instead, we're going for a higher sales figure because it is more attractive to majority of our stakeholders. Next, we have regulatory considerations. So, managers may make accounting decisions to influence regulatory outcomes. So, of course, businesses would have to follow the rules and regulations of governing bodies such as, but not limited to, the BIR and the SEC. So because of these regulatory considerations, the managers would have to align the accounting choices on the regulatory outcomes that they want. We also have to consider the capital markets. So why does the capital markets affects the management choice on the accounting policies? It's simply because managers may make accounting decisions to influence the capital markets. We're always taught in finance that the ultimate goal in business is to maximize shareholder wealth. So in order to do that, you must be able to increase the stock price of the firm. So there are a lot of factors that could lead to an increased stock price. And if you want to influence your stock prices, you must also show a positive performance in your financial statements. So how do you do that? It's not just, okay, I'll sell more, I'll spend less. But it's also because of, okay, I'm going to take advantage of a certain accounting policy and a certain accounting estimate that is acceptable and is more favorable in terms of income or in terms of showing profits to our stakeholders, because this particular policy may lead to a higher net income, and a higher net income would mean probably a higher earnings per share, and a positive earnings per share could mean that the company is actually doing well and the investors are making the right choice by investing in your company, therefore making it more attractive for investments. So if there are more investors that are taking notice of your company, there would be an increase in the demand for your stocks. So your financial statements or the contents of the financial statements can actually influence the capital markets. And it's not just in stocks, but also in other financial instruments. We have the last two. So these are the last two reasons or considerations rather why management is choosing or management is looking at the different accounting choices available to them. Stakeholder consideration. So when we say stakeholder consideration, managers may also make accounting decisions to influence the perception of the important stakeholders. So, of course, the financial statements, like I said, is a tool of communication. It's being used to communicate financial data to investors and the public. Especially so if you have a high profile group of investors that you may want to impress. So you can actually choose among the acceptable accounting standards the best choice if you want to impress your stakeholders. Lastly, there are also competitive considerations. So we're going to be talking about here the dynamics of competition in the businesses or the firm's industry. So if the firm is in a very competitive industry, it may have a different set of accounting policies and standards compared to the other firms that it is competing with. So basically, what we're saying is the presence of human will and the power of choice actually affects the factors or affects accounting quality. So in the next video, I'm going to be discussing the second half of this module, which is the steps that we do in accounting analysis. So I hope you stay tuned for part 2, and I'll see you then. Bye!